Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Welcome back to the deep dive. Today we are tackling probably the single most important metric in corporate strategy, and frankly, it's the one that gets ignored the most until things, go really wrong. We all see the headlines about growth, companies announcing these massive expansions, buying competitors, launching moonshot projects. It all sounds great. It's sexy.
Drives the stock price for a little while anyway.
Exactly. But in going through the Corporate Finance Institute's fundamentals and some of these case studies we've got, there's such a clear line between growth and actual value.
Mm-hmm.
And that line, that distinction, it almost always comes down to this one invisible price tag.
This is the price of the money itself. It's funny, in the startup world, everyone's obsessed with burn rate.
Mm-hmm.
But in the mature corporate world, we sometimes forget that capital isn't free. Even your own cash isn't free in the economic sense.
And that's the cost of capital. And look, we're not going to do the textbook definition hour today. If you're listening to this, you probably know it's the return investors demand for the risk they're taking. What I want to unpack is how this number acts as a sort of gravitational constant for a company.
Mm-hmm.
It dictates everything from whether Microsoft can afford to pump billions into OpenAI to why a company like AMC gets trapped in, a death spiral.
It's the strategic filter.
Mm-hmm.
That is the best way to think about it. It's not just a number for an SEC filing. It's the hurdle, the thing that separates a good idea from a really value-destroying mistake. And the sources we're looking at today really highlight that this isn't static.
Yeah.
It's a living, breathing metric that changes with the market, with rates, and this is the big one, with trust.
Okay, so let's get into the mechanics just for a second before we hit the cases, because I think the components of the WACC, the weighted average cost of capital, they tell a story on their own. You've got your cost of debt and your cost of equity. Now, debt seems pretty straightforward.
It is.
You borrow money, you pay interest, and the government actually gives you a little incentive with the tax shield.
Right, and that tax deductibility of interest is a huge lever. It's like a subsidy for corporate borrowing.
Yeah.
If you're paying, say, 5% on a bond and your tax rate is 21%, your real after-tax cost is much lower.
Which is why stable companies love debt. It's cheaper capital.
It is, but it comes with bankruptcy risk. You have to make those payments no matter what.
Okay, which brings us to the murky part. Cost of equity. This is where I feel like finance becomes more art than science.
It can feel that way.
There's no invoice for equity. You don't send a check to your shareholders every month for using their money like you do with a bank.
Yeah.
But the source material is clear that this cost is very, very real.
It's an opportunity cost. That's the mental shift you have to make. Your shareholders could have put that money into an index fund or bonds or your competitor. By giving it to you, they expect a return that pays them for the risk of your specific business.
So even if you're profitable, if you don't beat that expected return,
You're failing them.
Wow.
You're destroying their capital's potential.
and this is where we get into things like the CAPM model, the capital asset pricing model. We're looking at the risk-free rate plus an equity risk premium times beta. And beta is the real wild card here, right? It's how much your stock zigs and zags compared to the market.
And that volatility is the killer. If your stock is all over the place, your beta is high. If your beta is high, your cost of equity just spikes.
Yeah.
Investors demand a huge premium to hold on to that kind of roller coaster stock.
So we blend these two, costs, debt, and equity, based on the company's capital structure, and out pops the WACC. Let's just say it's 8%. The sources use this term hurdle rate.
Yes.
I always found that image a bit simple, but the implication is pretty severe. If a company takes on a project that returns, say, 6%, but their cost of capital is 8%.
They are literally lighting money on fire.
But, and this is the trap, they might show an accounting profit.
Oh, absolutely.
The project made a 6% return, the division manager gets a bonus.
Right, on the P&L, it looks fine. It looks like profit. But in terms of what we call economic value, added EVA, it's negative. You have destroyed shareholder value. You used expensive capital to chase a cheap return. This is the growth trap.
That's why you can see a company double its revenue while its stock price gets cut in half.
Yes. The market is smart enough to figure out that the growth cost more than it was actually worth.
That distinction is everything. And speaking of getting it right, let's look at the gold standard case study in the data. PepsiCo.
PepsiCo is a fascinating one because on the surface, It's kind of a boring business.
Sugar, water, and potato chips.
Right. But their balance sheet management is incredibly sophisticated. It's a masterclass in optimizing their capital structure.
It really seems like they've managed to decouple their financing from the volatility of the broader economy. They have a target leverage ratio, and they just stick to it.
Consistency is the key word. Their cash flows are super predictable because they sell consumer staples.
Right.
That lowers their business risk.
And because they manage their debt so strictly.
They lower their financial risk. The result of all that is an incredibly low and, maybe more importantly, stable cost of capital.
So what does that low WACC actually buy them? I mean, they're not a high-growth tech startup.
It buys them strategic flexibility. I love that term from the sources. When your cost of capital is low, you just have more options. If a competitor pops up, you can acquire them. If the economy tanks, you can weather it. Or, as Pepsi often does, you can just return that cash to shareholders with buybacks and dividends.
Which keeps the stock price solid, which helps keep the cost of equity down.
It's the virtuous cycle. They effectively use their low cost of capital as a competitive moat. It's really hard to compete with a company that can finance its operations 2% cheaper than you can.
That compounds into a huge advantage over time.
A massive one.
Okay, now let's pivot to a totally different beast, Microsoft. We're going from consumer staples to, the cutting edge of tech and AI. But the principle seems to hold up.
It does, just on a much, much larger scale. Microsoft's balance sheet is a fortress.
Makes nation-states jealous?
It really does. They generate an obscene amount of free cash flow. They have pretty modest leverage for their size, and just mountains of cash. This gives them maybe the lowest cost of capital in the whole tech sector.
And here's where I want to connect the dots to their current strategy. We're seeing Microsoft pour billions upon billions into AI infrastructure.
Data centers, chips, the OpenAI partnership.
Right. These are hugely expensive projects with a payoff that might be 5-10 years away.
And that is the critical point. Duration. If you're a high-risk company with a WACC of, say, 15%, you cannot afford to invest in a project that pays off in 10 years. The math just doesn't work. When you discount those future cash flows back to today, the project looks terrible. You need returns right now to satisfy your nervous investors.
But because Microsoft's WACC is so low, they can afford to play the long game.
Exactly. Their low financing friction, as the sources call it, lets them make bets that their competitors just can't afford to make. It's a mathematical impossibility for them. Microsoft can look at a data center that won't be profitable until 2030 and say, yep, this clears our hurdle. A weaker company would have to pass.
So in a way, a low cost of capital is like a time machine. It lets you pull future value into the present without getting crushed.
That's a brilliant way to put it. It elongates your strategic horizon.
But of course, the sources also gave us the nightmare scenario. We have to talk about what happens when the math breaks.
The death spiral.
The case study here is AMC Entertainment and, more broadly, the whole distressed retail sector.
Yeah, it's the inverse of the PepsiCo virtuous cycle.
Yeah.
AMC went into the pandemic with a balance sheet that was already really heavy on debt.
High leverage plus vanishing cash flows.
A toxic combination. Suddenly, the risk part of the equation just exploded. Lenders looked at them and said, I'm not sure you're going to survive this.
So their cost of debt just skyrockets.
At the same time, equity investors see the risk. The stock price collapses or, becomes incredibly volatile, which spikes the cost of equity.
I do want to touch on the meme stock thing here because AMC's stock price actually soared for a while. You'd think that would lower their cost of equity, right?
It's a paradox. And yes, they were able to raise a lot of cash by selling stock to retail investors. It saved them from bankruptcy temporarily. But from a traditional valuation standpoint, the volatility of that stock went off the charts. The beta was insane.
So institutional investors couldn't touch it.
Exactly. So while they got a cash injection, their long-term stable cost of capital was still broken.
And the operational impact of that? The sources say when your WACC spikes like that, management basically loses control.
You stop playing to win, you start playing not to lose. When your hurdle rate jumps to 15, maybe 20%, almost no project makes sense anymore. You can't renovate theaters, you can't upgrade your equipment. All your cash has to go to just servicing the debt.
It forces this extreme short-termism. You slash costs to survive, which degrades the product, which lowers revenue, which scares investors even more.
And that is the vicious cycle. The cost of capital accelerates the decline. It's like gravity getting stronger as you get closer to a black hole.
Let's talk about the people actually punching the numbers, the CFOs, the finance teams. The sources had this section on modeling risks that I found pretty damning.
Internal optimism,
Mhm.
or as I call it, corporate p-hacking.
Yeah.
See, WACC isn't a number you just look up. You have to calculate it.
Yeah.
And there are these inputs, like the equity risk premium or the risk-free rate, that are open to interpretation.
Especially right now. I mean, what is the risk-free rate today? The 10-year treasury yield that's been all over the place?
Exactly. So if a finance team really wants to get a pet project approved, but the WACC is just a little too high, there's a huge temptation to just tweak the inputs.
Oh, let's use a slightly lower beta.
Let's use the 5-year average for the risk-free rate instead of today's rate.
You nudge the number down from 9% to 8.5, and boom, the project clears the hurdle.
And everyone's happy for a while. The project gets funded. But the economic reality hasn't changed. You've just rigged your own model. The market eventually punishes this. If you consistently invest in these subpar projects, your return on invested capital will go down, and investors will notice.
It just brings us back to that idea of trust. The expert commentary in the notes made a really profound point. Cost of capital is basically a metric of trust.
I think that's the most important takeaway for any leader listening. Why is Microsoft's capital so cheap? Because investors trust the cash flows. Why is a distressed retailer's capital so expensive? Because the trust is gone.
And this isn't just about the financial statements. It's about communication, transparency, having a coherent strategy.
Absolutely. If a CEO is erratic, if they pivot strategy every 2 quarters, if they keep surprising the market with bad news, they are introducing volatility. They are effectively raising their own WACC. Investors charge an uncertainty premium.
So a boring, consistent CEO is actually a financial asset.
Boring pays. If you can convince the market that your future is rock solid and predictable, the market rewards you. It lets you borrow and raise money for next to nothing.
That is the ultimate competitive advantage. It reminds me of that old saying, reputation arrives on foot but leaves on horseback. In this case, when it leaves, it takes the stock price and leaves you with a higher interest rate.
And once that WACC goes up, it is incredibly hard to bring it back down. It can take years of disciplined execution to rebuild that trust with the market.
So pulling this all together for our listeners, whether they're managing a P&L or just their own portfolio, the core lesson seems to be about looking beyond that headline growth number.
It's about demanding value, not just activity. If you're an employee, look at how your company makes decisions. Are they rigorous about this stuff, or do they just chase shiny objects? If you're an investor, look at the spread between a company's return on invested capital, their ROIC, and their WACC. That gap is where the magic happens.
If ROIC is higher than WACC, they're creating value. If it's lower,
they're destroying it. It's that simple.
It's simple to say, very hard to do.
That's the game.
We're going to wrap it up there. A huge thank you to the Corporate Finance Institute for the data that powered this deep dive. For anyone who wants to get their hands dirty with the actual math calculating betas and all that, that's the place to go.
It's worth the headache, I promise. Once you see the matrix, you can't unsee it.
The invisible price tag on everything. Thanks for listening, and we'll catch you on the next deep dive.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.